Just check in on the Kenyan market for the day. Just checking in how the equity market closed for this Friday session. 4,821 points. You're looking at the market up by 0.7%. And just a quick check in on how the currency is faring in all of this. 83.55. A shilling strength coming through up around 0.5%. Certainly interesting signs, signals coming through from the Kenyan markets. We've had strong demand also coming through for certain long-dated bonds. So let's get into all of this. Crossing over to Nairobi, we've got our market watcher, Kenneth Minjire, fixed income analyst at Stanlib Kenya, standing by. Kenneth, thanks for joining us. So there we go. We've got a picture of shilling strength on this Friday. The equity market is up, and certainly bonds have been stronger once again this week. Run us through your view of what's driving sentiment right now.
Yes, it's true. It's been a very interesting week. We've seen rallies on both the equity and the bond market. I think more on the bond market. The equity market, what we've seen is more of a recovery driven by price gains in the large caps. But for bond market, we've not seen such turnovers for quite some time, especially where more than 70% of the turnover is driven by bonds, long-dated bonds with tenors of 10 years or more. So this is quite interesting. It also shows that market risk appetite is growing because what we're seeing is more investors looking at the long end of the yield curve, which has actually been a no-go zone for, I think, probably the last 9 to 12 months. So this is quite good. It shows market sentiment is positive. They expect rates to move in a certain direction, which is downwards. And we expect to see the rates continue to come off, as we've seen with the prime rates over the last, I'd say over the last 4 weeks, actually 6 weeks to be precise. We've seen the 1-year T-bill come off all the way to about 12.1 this week. We've also seen the 91-day just about to cross below the double digit, just about to cross 10% to probably expect next week it may touch levels of 9.9, probably the upper nines. This is all positive news for the bond market and for interest rates. And I hope this actually filters through all the way down to the commercial lending rates. But we may see something more concrete once we have the MPC meeting, which is slotted for later this month.
I mean, that of course is one of the big issues right now. You know, when are commercial banks really going to respond to this low interest rate environment in the way that regulators are calling for them to do that? Do you think that there's going to be increased pressure on commercial banks right now, given the fact that, I mean, as you say, rates continue or yields continue to come down across the board?
I think what commercial banks would be looking for is a more definite trend. Because basically, of course, we've seen our bond market can be quite volatile. It can be down today and up the next week. So what they'll be looking at is a more tangible trend. And going forward, I think they're also looking at, I think the budget estimates were out yesterday with the government looking to borrow about 1.6 trillion. So it wasn't as heavy or as expected, but still, I think going into the new financial year, banks will be looking really closely to see whether they'll be competing for funds with the government. But I think once the sovereign bond comes through and we're able to plug the deficit, plug the gap basically, and also reduce on the pressure on domestic borrowing. I think this will actually be quite an incentive for the commercial banks and will be a definite signal that rates are headed in one direction. Also, this government has been talking a lot about control in recurrent expenditure. This is a positive. They're able to implement these austerity measures. I think we should see the rates continue to come off, which should give the banks a definite signal.
So you're also talking about
bringing down their lending rates.
So we're also talking about austerity in Kenya now, Kenneth. Of course, the big buzzword on global markets. But when we talk about domestic borrowing requirements, 114.1 billion shillings is what they're looking to raise from the local market. I mean, what is your assessment of that number relative to expectations at the beginning of the year? And of course, the makeup between 30% from the T-bill market and then the rest of that coming from treasury bonds?
I think it's actually very, very achievable. If you look at our borrowing target for this financial year, it went up all the way to about 167 billion. And we've been able to actually meet Okay, currently we're at about 90% of this target, and it could be covered in the next 2-3 T-bill and bond, the next 2 or 3 T-bill auctions. But it's been comfortable. CBK is comfortable, and despite this heavy borrowing, which is actually the highest we've ever had, we've seen the trades have still coming off. So 114 is actually, that's a lot less than we had the previous actually in this financial year. And I think basically, it wouldn't be much of a problem. And also, you've mentioned T-bill and bonds. There's actually a debt program that began a couple of years ago, about 2008, where they're looking to lengthen the maturity of government debt, which is currently stands at about 5.3 years. So they're looking to lengthen this. There's actually legislation. There's a paper they're working on that should be tabled in our parliament soon, that will actually regulate this tenors and the average length duration of our debt. So I think this will be taken off quite. It will be okay.